Welcome to the daily update, where I'll go over the action in the market for Thursday, October 17th. Then we'll see how things look for Friday, October 18th. Well, we had a pretty solid open, but we set the high right at the open, and we spent the rest of the day chopping lower, and we ended up closing down just slightly, virtually unchanged, but it goes in the books as a negative day. But we had the Dow setting a new all-time high. And the economic reports that came out were stronger than expected when you take them all together. And this is causing some concern in the market that, maybe a strong economy will prevent the Fed from continuing along this path of cutting rates. Now we'll have to see as more economic reports come out. Is this a viable scenario? Is this just a short-term thing that the market is working through and then they'll get back to this idea that the Fed's going to keep cutting rates without necessarily going into a recession? And then there's been some developments in the Middle East, but that really hasn't had an impact on the markets. I do have a thing called the SPXInvesting Program. It's up, it's going, it's free until the end of 2024. If you want to learn more about that, there's a link in the description below this video that will take you to the website, as well as to a video that talks about the program. One benefit is you get access to the videos that I produce right as they're available, where I keep them locked down for a little bit on YouTube and Rumble. So feel free to check that out and see what you think. And if you have any questions, here's an email address that you can certainly ask me any questions. The daily video is the real foundation of the analysis that I do. I put out a number of different videos each week. The videos around the outside are weekly videos, but they're all meant to tie into the daily video. Okay, let's go back and talk about what happened and then look at some charts. We had a gap higher open. The futures were quite strong. It seemed like, okay, things were looking pretty good. We opened above R2 at 58.71, but that set the high for the day. We declined down below R1 at 58.57, and we went all the way down to the unchanged level. We tried to rebound back up, and we got above R1 and almost to R2, but then we chopped sideways for a while, and then we declined to close slightly below the unchanged level. We were down 0.02% on below average volume. We're kind of back into that type of mode again here. The only above average volume day we saw was Tuesday, which ended up being a little more significant decline. But we're still positive in the short, intermediate, and long term. We're watching the inflation and interest rate scenario to see if these stronger than expected economic reports are going to continue to cause some more concern. We'll just have to see as they unfold. And then the geopolitical events that are happening. There was the head of Hamas was apparently taken out, and really no impact on the stock market, but it does have an impact on what's happening in the Middle East. Some comments. We did see a close or a mixed session as far as the indexes. They closed mixed. The semis ended up having a pretty positive day as far as the sector itself. And as I said earlier, the Dow did set another new all-time high. We're still under 20 with the VIX. Now, we're still getting a high reading, and I have kind of an interesting chart to show later that gives a little bit of a different perspective on the VIX. And then the things that are happening in the Middle East, oil is just continuing to drop. We're getting closer down to that 70 level. On a short-term basis, we still have our Williams percent R, the CCI 14, N20, and stochastics that are looking extreme. Now, it depends on the context. You want to choose to look at those charts. This is suggesting good momentum, but we keep an eye on sentiment and some other indicators as well. And when they start to get too far positive, then that's when we consider the market to be overbought. The intermediate term, the Arun indicator, the PMO studies, the rate of change going back 50 periods, the Sean trend meter, the bullish percent index for the S&P, the 100 period moving average study, and then the 10-day study of the new highs, new lows for the S&P. There's really been no changes to this list. Now, again, just like with the short-term indicators, you can say, oh, this is pretty good momentum. But at the same time, Sometimes the market can get overextended by going up too far too fast. And then the long-term list is the 150 and 200-day simple moving average, as well as the exponential moving average that we have on the S&P itself. And I'll show you charts of all of these. I did add something to the current scenario where they're now asking a question: will economic strength threaten rate cuts that the market is pretty much assuming will happen? The dollar was up and interest rates were up on this stronger than expected economic news. We closed at 4.08% with the 10-year yield, where we had been at 4.02%. So that's quite a big jump there. We're still inverted with the 10 to the 3 month, but the 10 to the 2 is remaining uninverted. We ticked up a little bit with sentiment. We're at 72. So we're still positive altogether, but even with the slight down day, but we saw the mixed closes with the different indexes. So this actually helped things, even though this sentiment is really based around the S&P 500. It's when we get to that 75 level, that's when we start to look extreme as far as sentiment. We're still positive with our trend. The ADX is above its moving average. It's green. The green line actually went up, even though we had a slight down day. But the bias, I've switched over to negative just because we had a slightly negative close. However, the momentum over the last 2, 3, 4, 5 days taken together continues to be positive. So this is the big day that we had economic reports coming out. Weekly jobless claims. Now, they expected 270,000. It came in at 241,000. So this is showing more strength than what the market had been anticipating. And then a week ago, we saw 260,000 release, and that was a jump up. Continuing claims are still continuing to go higher. They're at 1.867 million. A week ago, they were at 1.858 million. Retail sales, this was also quite stronger than expected. They thought it was going to be up 0.2%. It came in up 0.4%. Last time it was up 0.1%. When you take out autos, also much greater than expected. They thought it would come in up 0.1%. It came in up 0.5%. Last time it was up 0.2%. The Philadelphia Fed index came in at 10.3, greater than the 4 they had expected, and up from the 1.7 that was seen last time. Industrial production actually was weaker than expected. It came in down 0.3%. They expected it to be down 0.1%. Last time it was up 0.3%. And capacity utilization, also a little bit weaker than expected at 77.5. They thought it would come out at 77.9 and down from the 77.8 that was registered last time. Business inventories came in as expected, up 0.3%, and also the same reading that we saw last time there. So looking at some charts, here are the core retail sales year over year, pretty much flat right now, not really declining, not really going up. But it's just showing that people are still buying things, and that's a huge part of the U.S. economy. Month over month, we did see a pickup greater than expected with retail sales. The Philadelphia Fed Manufacturing Index also showing a stronger than expected reading here. And then capacity utilization, that's the yellow line here. It's actually coming down a little bit, but still positive, where industrial production is below zero and actually declining. So we're seeing not as much output, but people are still buying lots of things. And then capacity utilization here is declining. It's well off of that 80 level. When we get to 80 or above, that usually means that at least from a manufacturing perspective, the U.S. economy is chugging at full steam at that point. And then month over month, we did see a decline in the industrial production. Then the NAHB Housing Market Index is going up here still. And then this is kind of interesting in that we saw a real drop off in the weekly jobless claims, but the 4-week moving average is still continuing to go up. That's because of that really big jump that we saw a week ago. And continuing claims are also starting to go up here. So when you look at the jobless claims, a real drop down, that was showing that there's still strength in the economy. But folks that are extending out unemployment a little bit here, that continues to go up. So we're getting a little bit of a mixed picture based on these charts. So we take all of this together with the latest unemployment rate. We see all the decline in jobless claims and still a gradual increase in the continuing claims. Then looking at some internet or Isabel Net blog charts here. This is put out by Real Investment Advice, and this is comparing GDP, which is in black, with the year-over-year earnings per share change. And there tends to be a pretty strong correlation between the two. And this is just giving you an idea of where we're at right now. And this is something that I go through in our charts right here. We keep a really close eye on the advanced decline line. I do a lot of different studies here, but really the takeaway from this is we're breaking out and setting new all-time highs with the S&P. We're also breaking out with the advanced decline line. So that's just showing internal strength and a confirmation of the new highs. Then they were starting to look a little bit ahead to November here, where it says median monthly flow into equity funds and mutual funds. We tend to see a lot of money coming into the market in November. And Bank of America private client weekly outflow from T-bills. These are shorter term, and we're seeing a lot of money coming out, and that's pushing interest rates back up on the shorter term perspective or the maturity rate of the treasury bills. And I usually don't show this chart because it doesn't really tell us all that much, but this is a variation put out by Morgan Stanley of a sentiment indicator. And we're getting up into this higher area right now, which might mean that we're getting a little too positive as far as sentiment. And then just as the U.S. economy or as U.S. equity market outperformance has reflected stronger fundamentals, so has the tech sector. And this is just showing the world tech sector. You take everything all together, and it's really doing quite well. And then this is the whole world. You take out what's happening in the U.S., and this just shows what an impact that the U.S. tech sector really has on the market. And here's some inflows and outflows. We're seeing a lot of money going into REITs. Those are real estate investment trusts and financials, which are doing quite well. Utilities, which have been strong lately as well. And we're seeing money coming out of the low volatility stocks. And I go over that in the weekly video where we compare a low volatility ETF with the S&P, and it's been continuing to underperform, where we're seeing things coming out of industrial staples, which is more defensive, discretionary, which that's more of a growth area, and we'd like to see money going into that. And then healthcare, that's also more defensive, and energy's been under a lot of pressure, as has Japan. Buybacks by corporations, it's off historical highs in June, but still giving us a very high reading right now. And then looking at the U.S. deficit here, where these are just some projections going out, and this just shows that, and you can kind of thank modern monetary theory for some of this here, that we're just going into more and more debt, and it's as a percent of GDP. And then the Bank of America, the sentiment sees the biggest monthly improvement here, where people are just feeling better about things. And you can go back and look at different events that have happened and then what sentiment was like at that time. I did find this chart. This is put out by Sentiment Trader, where we've been keeping a really close eye on the VIX lately. We're getting high readings, even though the S&P is just coming off of setting all-time highs recently, and the Dow's setting all-time highs, but we're still getting very high readings with the VIX, even though it's now dropped below 20. Well, what they've done here is they've come up with a comprehensive model, thinking that, well, maybe we should be quite a bit lower than where we're at right now. There's a really wide spread between the real VIX that we follow and that most of the market follows, and then what the synthetic estimated VIX down here. Yeah, I don't know how much importance to put into that, because when you build your own model that the market really doesn't pay attention to, that means they're not really reacting to it. And so it often ends up not being all that relevant. But I did think this was interesting. The idea that we're very high with the VIX, with the S&P holding up as well as it has been lately. And then this is more for informational purposes. This could lead to a real house of cards, because credit card debt is hitting a fresh high right now. And that folks are just, it's just showing that they're struggling economically. And so they're having to use their credit cards just to get by each month. And at some point, that could really produce some issues. And then one thing that's interesting, we're seeing kind of a shift lately. And according to this, JP Morgan says the financial markets, they're starting to price in a Trump win. I'm not sure how you actually measure that, but he's more of a businessman. And so the market may like that. But, the market has friends on both sides. They don't really care if it's Democrat or Republican as long as they can have some influence on whoever's in the actual office. And they're also looking at a possible Republican sweep. That would actually be more negative for the market because the markets like having Congress split between Democrat and Republican because then they have a less tendency to be able to actually do something. And usually when Congress does something, it's passing rules that businesses may not like. Okay, let's go look at the intraday chart here, where we did spike up. We had a really solid open, but it just kind of stopped right there. We came down from that. We were above R2. We came down and quickly became below R1. We just about got down to the unchanged level, tried to bounce back up, and then chopped sideways for a while. And then some kind of sell program, things started to hit the market and really took things down again below R1. And we tried to bounce up a little bit, but ended up coming right back down to the unchanged level. So it was kind of one of those treadmill days where you just run and run and run, but ended up not really going anywhere. And not seeing much of a reaction, at least in the initial overnight session yet here. But the futures had been strong before Thursday's session, and then it led to a really solid open, but then it just didn't carry through into the cash session. And we are seeing where growth is underperforming value here. The blue line is, excuse me, is underneath the red line, where we had been seeing the blue line above the red line, and that really helps the market to go up. Well, with the blue line dropping down, that means value is outperforming. Now, the market can still go up, even if value is doing well. It just means that more stocks are participating. But when we get the really solid up moves, we tend to see the blue line above the red line here on the intraday chart. And coming back down after we were looking better with the S&P growth of value intraday chart, it was looking pretty solid, and that was helping the S&P to go higher. Now we're kind of showing some weakness lately. Even though it was positive in Thursday's session, it really came off of its highs, but it still ended up closing positive with this ratio. Our end of day chart growth was up where value was down. It was up a little bit more for the mid caps and it was down more for the small caps. So we're still not looking all that solid here. When we look at S&P growth to value and look at the ratio with that, also declining with mid cap growth to value and ticking back up a little bit, holding up okay right now with S&P growth to value, but we want to see this continue to go up if we're more positive on the market. Not looking really good here with our growth versus value ETF. We're coming back down and getting close to this 250-day moving average near the lower end of the rainbow. Looking at the spread or the ratio between discretionary and staples, still holding up fairly well, where we're seeing discretionary doing a little bit better here and a little bit of weakness with staples. And so that's helping this ratio continue to go up. Large cap growth, though, it was up slightly and still looking pretty solid there. Our trend is positive. We're seeing the dark line here, which is the ADX above the moving average. And even with the down day, the green line is turned back up. So this is still looking positive. And we're also looking positive here in the short term as well. But volume is still below average. Sentiment, we're below 20 with the VIX, even though we're still getting quite a high reading, both with the line chart and the bar chart. The VIX of the VIX is kind of right in between these moving averages, coming down closer to the bottom moving average, but still getting quite a high reading. This tends to move hand in hand with the VIX itself. So if the VIX is going up, the VIX of the VIX also goes up and vice versa. We're actually rolling over a little bit. We've seen enough of a decline with the VIX lately to get the MACD to roll over, and it's starting to cross below its moving average. So the momentum is actually shifting to down, which could be more positive for stocks. The historical chart, we just really haven't been pairing up with that seasonally with what's been actually happening. But we're still concerned here with the VIX to S&P correlation. We're still getting quite a high reading. The market is nervous. And this is why Sentiment Trader put out that other chart saying, well, when we create our own little VIX here, things are looking a lot better. And the VIX is higher than it should be. And that's why we're getting a really high reading here. But the market looks at this. And so we're watching this to see if that is going to have an impact. And because the market is getting nervous, this could mean once we finally drop, that is because the S&P ends up declining. But we're just not seeing that really playing out right now. Also getting a high reading here with the SKU index. We're still up in this red area, and it's been well over a week now that we've been seeing these readings. We were up with this one fear gauge and just declining with this other fear gauge. So we're getting a little bit of contradiction here as far as the other sentiment gauges that we look at. We did get the weekly reading from the American Association of Individual Investors. They dropped down. They were more positive a week ago, actually coming down just a little bit in the latest reading. But overall, you look at the moving average here based on 50 periods, it's still continuing to go up. So sentiment is still positive. And not seeing much of a change here with the risk on to risk off. We had been going up, even though over the last couple of sessions we've been pulling back here. When this is going up, that means it's more beneficial, or we call that risk on, and that helps stocks more. When this is going down, it's more risk off, and the market is becoming more defensive. Still getting a really high reading with the volatility risk premium as well. Really big move up here with the equity put call daily chart, enough to turn the 5-day back up, and we're no longer extreme here. This could actually be negative for the market with this going back up now, and we're starting to see this coming out of this extreme negative range right here. And then the 10-day is also turning back up now. Now, if this continues, that could be more negative for the market with both the 5-day and the 10-day charts. But the advanced decline line still looking pretty good, just coming off of setting recent all-time highs here, both based on price and volume. So internally, things are looking pretty solid. Also, did see way more new highs than any new lows. We're going flat with the 5-day, but we continue to go up with the 10-day moving average. So this internal measure is also looking pretty strong. Came down just a little bit. We're no longer extreme with accumulation distribution, but we're still above an advancing moving average. So this is still positive. We're still positive when we look at the advanced decline ratio, and we're positive with the advanced decline ratio based on price and volume. And we saw a little bit of a move down here with the chicken money flow with the slight negative close. We were encouraged after Wednesday to see this really go back up and the red line going up. Now we're starting to come back down slightly. So we'll keep an eye on this, but it's still positive overall. We're actually declining with the chicken oscillator, but we're still above zero. And the vortex is showing the green line going up and the red line going down. So that's looking a little bit better, and it's positive. Looking at the cumulative advanced decline line for the S&P based on price, just coming off of setting an all-time high, also setting an all-time high recently based on volume. This is still looking pretty solid. Still showing how the S&P and the NYSE advanced decline line not really getting out of line with each other right now, even though they're on different scales. We look at the cumulative advanced decline line for the NYSE, coming down a little bit after setting a new breakout high here. We look at the regular NYSE advanced decline line, still looking quite solid. Here's another NYSE advanced decline line tick down, but still looking quite positive for now. The common stock based on price on the NYSE coming down a little bit, but just setting a new all-time high in Wednesday's session. Also still looking pretty good here based on volume. Our advanced decline line still looking good. We're above advancing moving averages, the moving averages here with the NYSE common stock, the S&P, the mid caps, and the small caps as well. Not much of a change here, but we saw small caps actually outperforming recently, and that's causing this ratio to go down, even though it ticked up just a little bit in Thursday's session. And here's the volatility risk premium, where we're still just seeing a really high reading right now. And then the stocks above their 20-period moving average did decline. We're no longer showing the good upward thrust right now. We dropped below that 70 level, but still looking fairly positive here. Decline, but positive with stocks above their 50-day moving average. Still extreme with those stocks above their 100 period moving average and declining a little bit with those stocks above their 200 period moving average. And you could see right here, there's a pivot point right here, and we could be hitting that upward resistance. We're also seeing this on the SPY chart that I do in different videos that I show on the website. But this could be providing overhead resistance here, and then we came right down from that. Another takeaway from this chart is that we're back to below average again with volume. So we declined a little bit, but still looking fairly positive with the 20, 50, and we're still extreme positive with the 200 period exponential moving average on the S&P itself. Still above the midpoint, but we're not extreme with the Stochk RSI, where we're coming down, but still extreme with the Williams percent R. The stochastics in the short term coming down, but still extreme. Also declining, but extreme in the intermediate term. Rolling over a bit here with the longer term stochastics. And the CCI 14 is declining, but still extreme, as is the CCI 20. The condition of the 20 period moving average, our short-term trend, coming back down, and we're pretty much right at about the green line and the blue line, but still holding up for the time being. We haven't dropped below it, at least yet, either of these lines. And we're above the simple and exponential moving averages. This is also showing that the short-term trend continues to be positive. And as I've been trying to point out here, we're seeing a series of higher highs and higher lows. We'll see if we can break out and set more new highs with this, or if we start to come back down, that may make this rather healthy looking set of bars here not look as healthy. The force index right about at the midpoint, but still positive. We're just at the upper end of the +2 channel with our standard deviations chart. Intermediate term declined a little bit with the balance of power, but still positive. The condition of the 50 period moving average, which is intermediate term, we came down, but we're still above the red line and the blue line. The go no go system still has the darker blue bars, which are positive, and we're just coming off of setting a new high here with the highest high value. That's still holding up quite well, but we've been watching this now for a while. The TTM squeeze is continuing to decline with the darker blue bars. That's more negative. The rate of change going back 50 periods, we're above this 10 level here, which sometimes that can mark at least a slowdown, if not an exhaustion, and sometimes even a reversal when we get to a high reading, such as this one. We're still above zero with the ease of movement, so we're positive there. The Arun is going back up just a little bit, giving us an extreme positive reading. We declined, but we're still positive with the S&P McClellan oscillator, so we're going up with the summation index based on price and volume. So this is still looking fairly, or actually quite positive for right now. We declined with the NYSE McClellan oscillator, but we're still above zero, so we're starting to turn back up with the summation index based on price and volume. And we're seeing a little bit more of a confirmation here. The Swenlin trading oscillator based on price is continuing to go up, and it's starting to turn back up after spending a couple of days being flat on with volume, but we're still positive since both price and volume are above zero. And the momentum is showing some improvement. The PMO is above its moving average, crossing back above the moving average based on price, and we've already crossed above the moving average based on volume. Even though we declined a little bit with the PMOs that are rising, the buy signals are still going up, and we're still getting a really solid high reading with the PMOs that are above zero. We've gone from positive to neutral with the Elder's Impulse system for the S&P, but we're still positive with the parabolic SAR since the dots are underneath. Trying to turn back up here, but pretty much on top of the moving average with the slope oscillator, a short-term oscillator, but the MACD is looking more positive. So trying to show some improvement here in the short term, looking more positive in the intermediate term. The TRIX, which is a long-term oscillator, is looking a little bit better, starting to go back up. We're showing some improvement with the KST, another long-term oscillator, but we haven't come back above the moving average yet. And the Copic curve is trying to come back up and cross above its moving average, but it hasn't quite done so yet. The Sean trend meter still giving us a very high reading. You could say that that's extreme positive. Going back up and above 50 with the money flow, coming down, but still above 50 with the ultimate oscillator. On balance volume continues to be positive. And I added some green areas in here. When we're above 50, that's just showing longer term solid momentum, both in the intermediate term and in the short term. And that's what we're seeing right now. We're still above all the plotted moving averages here, and all of the moving averages are going up. Bullish percent index still giving us quite a high reading, even though it did decline slightly. And we're really showing a good reading here with the NYSE bullish percent index, but we're declining. However, we're still above 50 with the NASDAQ 100 bullish percent index. And still looking good here. And you can see just beginning of 2024, this is a weekly chart. Yeah, we had some pullbacks along the way, but this is just showing really solid upward momentum longer term. And we're still looking pretty positive here with the Heiken Ashi with the open candles. We're pointing back up now with the Kigi chart in black. That's positive. The Renko chart continues to be positive with the open blocks, and the three-line break is also positive as well. Long term, still holding up quite well with the 150 and 200 period moving averages. Still positive across the board on all different time frames with the S&P, mid caps, small caps, and NASDAQ 100. Bonds are under pressure in the short and intermediate term, where commodities are kind of all over the place. They're negative in the short and long term, but positive in the intermediate term. And the dollar's just really been showing some strength. Now, the chart that I show still has us in a downtrend. That's a 50, 200 moving average crossover. But using some other measures, the dollar, after coming down to 100, has really been showing some strength. And we did have, let's see, four of the sectors positive, with energy, tech, financials, and materials being positive. Utilities ended up being down the most here. And real estate, which they don't like the fact that interest rates are going back up. Healthcare, which is more defensive. Communication, which is more of a growth area. We would like to see that do better. But staples is more of a defensive area, and they were under pressure as well. And saw mostly uh, green or blue here. We did see a BPI cross below 70 with communications, which is a growth area. But we had Canada just right after the open setting an all-time high, as did the S&P. Didn't stay there, but at least it set an intraday all-time high. And the NASDAQ showing a little bit of a bounce, and then the Dow ended up crossing back above 43,000 and setting an all-time high as well. Not really seeing much of a disconnect yet from the equal weight versus the weighted version of the S&P. And here's the Dow. And notice this R1 level here. This may be providing overhead resistance, and we're also seeing that on the S&P. But we're positive when we look at the diamonds with the Elder's Impulse system. Not really near a pivot point here with the NASDAQ, but it was virtually unchanged on the day. And up just a little bit was the NASDAQ 100. And we're still neutral with the QQQs when looking at the Elder's Impulse system. We're a little bit concerned about this. The PPO is starting to roll over and drop below its moving average. That's suggesting that the NASDAQ 100 momentum is starting to switch over negative. Small caps, we're down just a little bit. We're wondering, they're at the higher end of this recent range here. Are they going to stall here and fall back? Or are they going to finally be able to break out to the upside? We look at the Russell 2000 small caps. We're getting extreme positive, but starting to come down here with the RSI. But the momentum is positive. We're still positive with the Elder's Impulse system for the small caps. Mid caps also up just slightly and looking a little bit healthier here. Also positive with the Elder's Impulse system. The Wilshire did not set an all-time high. It set an intraday high, but ended up closing down slightly. And also setting an intraday high, but ended up being down slightly, is the total U.S. stock ETF. And kind of chopping around here with the staples to tech ratio. When this is going down, that means tech is outperforming. And that's when we're more positive on the market. When this is going up, that means the market is getting more defensive. And that's what we see the trend actually doing. We saw a recent golden cross here with this ratio. But since then, this has been pulling back and just kind of chopping around a little bit lately. Financial sector looking really solid, setting an all-time high here. The FANG index was up 0.25%, still has a ways to go to get back to its all-time high set back in July. And we're right in between the shorter term trend line and this longer term trend line here with the FANG index. Apple was up slightly above its 50-day moving average. Amazon was up 1/3%, also has a ways to go to get back to its all-time high. We're watching Microsoft. We haven't seen a death cross here with these moving averages, but we're getting close. And Google was down over 1%, but still above its 50-day moving average. Nvidia ended up setting a new all-time high here as well. That's looking pretty solid. Meta was virtually unchanged, still looking pretty solid, even though it's coming down from recent all-time highs. Tesla was down 0.2%, still underneath its 50-day moving average. And Netflix, I don't know, they must have come out. Oh, they had earnings that came out that were not well received, ended up closing just a little bit below the 50-day moving average. And we are still seeing a weakening when we compare US stocks to world stocks with the short-term correlation starting to roll over a little bit here with the longer-term correlation. Oil's coming down just a little bit above 70 right now. And this is the dollar where it's just been really going up, even though it's still in a downtrend. It's just seen some real power lately. And we went back up with the 10-year yield, where that means we declined with the 10-year based on price. And not really seeing much in the way of growth to value improvement here. The Qs are dropping when compared to the S&P. Discretionary still, it's kind of flat, but it's below a declining moving average when we compare it to the S&P. Large cap growth, when we compare it to large cap value, just a little bit below its moving average. So the large caps showing a little bit of weakness coming down to an advancing moving average with the mid caps and dropping below the moving average with the small caps. And we want to see this going up. When we look at the S&P to utilities ratio, for the most part, it's been going back down. And this ticked back up a little bit, but this is actually more positive for the S&P. When this is going down, that means that the S&P is outperforming staples. And then just to give you an update of the Hindenburg-Ullman chart, no changes here. We're just clicking off days to see if this is going to end up playing into anything here. So what's our outlook for Friday? It will be options expiration. We'll have to see if there's a pickup in volume, if there's a pickup in volatility because of options expiring. We are still positive when we take everything together, but in the background, we have this confirmed Hindenburg-Ullman. And we're watching these VIX signals that we're seeing on some of those other charts that are showing that the market could be nervous right now. We're going to get housing starts and building permits, which are leading type of economic reports because you have to get a housing start and a building permit before you can start to do anything. So we'll see if that can help the market show some kind of conviction. And then any more fallout of things that are going on in the Middle East. They've taken out the Nasrallah, and that's when I was in Israel and decided to get out of there quickly after that was confirmed. And now they've taken out the leader of Hamas. Is this going to really pump up oil? What's Iran going to do with the Strait of Hormuz? You know, what is the US going to do are they going to tell Israel, don't do this, don't do that, type of things? Not much of an impact on the market itself, other than what's this going to do to the price of oil? Because that could end up bleeding over into what happens. And then here is the finishing up of the economic calendar for the week. This was Thursdays and all the big reports that came out. Seasonality, we're neutral to positive with the Dow and S&P, neutral to negative with the NASDAQ for October 18th. We are finishing out options expiration where we tend to be up more than down, but be aware the week after options expiration, we tend to be down more than up. So we see some positive seasonality going into October 18th, according to this chart. And Friday is the second most positive day when we compare it to what happened in 2023. It's also the second most positive day based on what has been happening in 2024. But I'm not really sure where this is all lining up here as far as seasonality. We just really haven't stuck close to that. And this is a chart that I showed a couple of days ago, and I want to keep showing this for a while. With the companies that are announcing buybacks, they still have blackout periods when their earnings reports are going to be released. And this is showing who has a blackout period right now. It's dropping down, but it's still a pretty high reading. And if these companies can't come in and start buying stock, that could limit the upside potential since they're often buying billions of dollars worth of stock. So what are the warning signs? We do have this confirmed Hindenburg-Ullman. We'll see if that ends up developing into anything. We're watching the more defensive areas like staples, utilities, and healthcare, energy more for geopolitical reasons, specifically oil. And we're going back up now with the equity put call 5-day and 10-day charts. And we're keeping an eye on growth of value, not really showing an awful lot of strength after it had been improving. Discretionary to staples is still looking good on a ratio basis. We want discretionary to see more follow through in and of itself to be more positive. And we're still getting a lot of VIX signals right now. We're still under 20 with the VIX, but still getting quite a high reading there. And then the positive signs, accumulation distribution, the Chaikin money flow, and the Chaikin oscillator, but it's declining right now, but they're still looking positive altogether. We have the S&P and NYSE McClellan oscillators and summation indexes, which are still positive. The advanced decline lines are looking good. We're turning more positive with the S&P 500 oscillators as well as the Copic curve. And with the bullish percent index, we're still extreme, but we haven't really been coming down yet with the bullish percent index there. Doing okay, still positive with the NASDAQ 100 bullish percent index, and really looking strong right now with the NYSE bullish percent index. The parabolic SAR is positive. The vortex is positive. The Swenlin trading oscillator, where we were seeing a divergence, where we're going up based on price and flat based on volume, they're both starting to go up now. The money flow, the ease of movement, and the ultimate oscillator are all positive. And we're watching this. I could have added this over to the negative side. The momentum for the NASDAQ 100 is looking like it could possibly roll over negative there. And the financial sector is still looking good here. So what's our conclusion? We're still positive, but we have this Hindenburg-Ullman and these crazy VIX signals that we're keeping an eye on to see if they're going to come into play at some point. We are positive, but a little bit overbought now in the short term. We're also positive in the intermediate term, watching the VIX, and we continue to be positive in the long term. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.